So guys, today we'll be starting off a new lesson called ratios, right? Ratio is a pretty straightforward chapter because the only thing what you have to be doing over there is simply look at your requirement, just check and see what is the ratio that they're asking for, and you simply copy this and you start searching for the elements. Okay, right? In this sheet you will have each type of ratio given over there. So generally you can have three types of ratios: profitability, liquidity, as well as what you can say leverage ratio. So in this document what it will explain to you is what type of ratio, what category it is, the given formula, what does the ratio explain, and how do you make a given decision, right? So over here in the last column, right now, for an example, 2013 A level paper, they have given you two companies and they have asked you to calculate ratios and they have asked you to say which company is better. So uh, one must understand that just because a ratio is giving you a higher answer, it doesn't mean that the ratio is correct, because certain set of ratios, higher the answer the better the ratio is, whereas certain ratios, for an example gearing or leverage ratios, the lower the ratio, so it's better for the company. So it's always better to memorize this table over here, so that in case your question is about comparing two different performances, you have to know which is better and which is not, right? So I will be doing two exercises over here in this video, and then I will give you the list of past paper questions which is in this tute, which I want you to attempt over there, right? So number one, right? So question number one is a very small and a simple question where they are asking you to calculate three set of ratios over here: quick ratio, gearing, and also return on assets. So the first thing what you have to do is, right, in your writing book, you draw a table which has three columns just like this, which is on the screen: formula, substitution, and the answer, right? So number one, quick ratio, you go and copy the ratio what is given in the tute, and in here I will help you on the substitution, right? So remember each ratio, there are a lot of ratios over here. Once I finish off a given calculation, I will give you a brief understanding on what this ratio means and how well the company can improve or worsen off, right? So number one, right, so current assets, right? So in this question, as you can see over here, the following data is extracted from Silva's company's annual financial statements for 31st of December 1996. Right, so number one, we have the profit and loss account and the balance sheet, right? So the first thing what we'll be needing over here is current assets. So when you look at your balance sheet over here, right, stock is a current asset, debtor is a current asset, and cash is a current asset, right? So stock, debtor, and cash, so when you add all that, you will get how much? 76. So you go and mark over there, right? Here we go, right? 76 minus closing stock. So as you can see over here, the closing stock over here is 40, right? So you deduct 40 from this, right? Minus prepayment, right? So now remember, though the formula is having prepayments, it is like a very rare occasion where you can see prepayments in a given question. So I'll tell you now itself, in most past papers the prepayment is always going to be 0. Okay, right? Right, so divide the whole thing by current liability. So as you can see, the only current liability over here is going to be the creditors, which is going to be 30, right? So you go and mark over there 30, done, right? So you use your cal and get your answer over there, right? Right, so the answer over there is going to be 1.2, right? Now remember, when you finish off a ratio, you can have a ratio in three given types, right? So now for an example, certain set of ratios like this where you multiply by 100%. So once you get your answer, obviously give that in a percentage. And then there are certain ratios like the one what we did over here, it's nothing. So in that case, you have to finish off this as 1.2 times. And then over here, as you can see, there are certain set of ratios where you multiply by 365. So in case the ratio is that way, what you have to do is, right, once you get your answer, now for an example, let's assume this is into 365, so you have to give your answer as 1.2 days. So remember again, you can have three set of ratios, one which you multiply by 100%, so there you give it in percentage. Certain ratios which is blank, so you finish off this in 1.2 times. and also certain ratios where you multiply by 365. So therefore what you do is you give your answer in days. Right, quick ratio, what does that explain? Right, now remember, quick ratio falls into the category of liquidity. So what does liquidity in accounting refer to? Right, when short term bills are being owed or when short term bills are being presented to you, how fast can a company settle? Now let's say for an example, an electricity bill is due. When the electricity bill is due, how fast can you settle it with your current assets? It's what is explained through the liquidity ratio, right? So over here what we are trying to do is we are trying to remove closing stock. In accounting, closing stock is the least liquid asset. So what we are trying to do over here is we are trying to remove the least liquid asset. After that we are going to see how well can a company settle its liabilities using current assets. So in this case it can settle up to 1.2 times, right? So remember, in a given industry, how to know whether your company is safe or not? If your ratio is 1:1 or more than 1, then your company is safe. So always remember, when it comes to quick ratio, the industry will accept a business if the ratio is 1:1, then the company is deemed to be safe. Right, so next ratio over here, right? So again they are asking gearing. So what you do, you look at the document and you copy the ratio and you start searching, right? Debt capital, right? Now remember, debt capital in advanced levels is equal to non-current liability. So I'll put down here, right? So the types of non-current liabilities that you can find in your paper, so we go, right, debt capital is equal to, right, non-current liability. So in your exam, non-current liabilities will generally be lease creditor, right? Then you can have bank loan, and you can also have something called a debenture. Right, so remember, for advanced level purposes, if they ask for debt capital, then you have to start searching for these three: lease creditor, bank loan, as well as a lease creditor, right? So in this question, as you can see, the only non-current liability over here is going to be this 40 debenture, right? So you mark that over there. So debentures over here, right, 40. Right, owner's equity, right? Now remember, in advanced level, equity will be equal to three things. One is ordinary shares, plus reserves. Now what do you mean by reserves? That will be general reserve, retained earnings, and also revaluation reserve. Right. So one more time, equity of a company in advanced level will only include ordinary share and reserve. So if I mean reserve, it means general reserve plus retained earnings and also the revaluation reserve, the reserves what you study for your company accounts, right? So number one, owner's equity, right? So the first thing what I need is my ordinary share. So over here the ordinary share will now be equal to 60, right? So you go and mark over there. Right, 60. And also as you can see, there's a reserve over here, so that's plus 5. Right. Right, so the answer for that will then be right. So it's coming as 61.5, so we can round that off to 62%. Right, so remember, what does a gearing ratio explain? Right, now normally when you start off trading, a company's capital will always include equity capital. So equity capital means generally what shareholders invest, And also inside your capital you can have debt. Now for an example, let's say you're finding it difficult to run the company, so you might take things like bank loan or you might take debentures, right? So this ratio will explain from the total capital of a company how much is obligation. So how much is obligations means how much has been taken from outside, right? So in this case, when compared to the equity capital, our debt capital or how much we have taken from outside is representing 62%. So remember, normally when you take a ratio, the lower the gearing ratio is, the safer the company. So normal practice, you will always want your debt capital to be lower than the equity capital. So in this case, they have borrowed more than your equity capital. So remember, what does gearing ratio explain? How much obligations have you taken when you compare to your invested capital, right? Then last part over there, return on total assets, right? So the first thing what we need over here is net profit after tax. So as you can see over here, the net profit is given, right? So you go and substitute that. Net profit is 3, right? Plus we need interest, right? So remember, in your question clearly they have given over here, as you can see, interest is 17, right? You go and add that. If interest is not given, what you should be doing is you have your debentures 40, multiply that by 10% and mark. That is if you don't have interest, but in this case interest is given to you as 17, right? And last one, we need total assets. So remember, in accounting, total assets means what? Current assets plus non-current assets. So in your balance sheet, the only non-current asset that you can see over here is 100. Current assets over here is 76. So therefore the total asset is now going to be 176. So again, how did we get here 176? Remember, total asset means what? Current asset and non-current asset. So current asset over here is 40, 30 and 6, that's 76. Non-current asset is 100. So therefore the total asset over here is 176, right? So for that one, the answer will now be right, so it comes as 11.3. I'll keep it at 11% over there, right? So basically ratio chapter is this much. The only thing what you should be doing is, right, number one, look at your requirement, start copying the formula from the table what I have given you in the document. Then start searching for the things over there, start substituting, and you have to get your answer, right? So I almost forgot, right? What do you mean by return on total asset, right? This is a profitability ratio. This will explain from your assets how much profit are you generating for your organization. So in this organization, we are generating 11% from the total assets over there, right? So with that, question number 1 is complete. If you have any doubts, you can message and ask over there on how to get the figures. I'll be explaining another one question and then you can do the rest of the past papers over there.